Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before getting into today's discussion, I'd just like to remind you all, if you like today's episode, don't forget to hit the like button and subscribe so you can get the latest episodes as soon as they're available. Okay, busy week this week, I think, particularly in the US. So let's start there because we've had, well, lots to talk about. So Jan, I will let you talk about all of that. But let's start, I suppose, we're recording this on Wednesday. So last night was the Fed renomination hearing for Powell. Did we learn anything new from that would shift the needle really on your expectations for the policy outlook for the rest of the year?
Whether it shifted the needle, I don't think so. We learned a couple of new things. I'll get to that. But I think most importantly is that Powell was very balanced in his speech. Going into the renomination meeting, there was a lot of hawkish momentum built in. I mean, markets were just selling off the front end, pricing in more hikes just because there was nothing new coming out, and there was strong inertia towards a more hawkish view on how quickly the Fed's going to react. I think at the renomination hearing, he was very balanced. Markets were braced for a continuation of this hawkish Powell, and they just didn't get that like 2 months ago. He acknowledged that 2022 was going to be a year for policy normalization, but we didn't really get any much more than that. Yes, we will see rate hikes. Yes, we will see balance sheet normalization. We already knew this. It's not really a new bit of information. And he didn't really go out of his way to emphasize any of those points. I just thinking about Powell's hearing, the most recent hearing in late November in front of Congress again, and he was so much more hawkish. He made this whole pivot about faster taper, about the need to react faster, retiring the transitory. I mean, we didn't get anything like that yesterday. So I think that was the main difference, and that kind of took a little bit off the steam, A, from the January meeting, and B, just from the building up of this rhetoric for no reason. The lack of commentary basically was as if they're giving more hawkish fuel to the market. And finally, on QT, we did get a little bit of information. So 2 things that are worth highlighting there, I think. The first is Powell confirmed that net purchases will end in March. Basically, takes off a lot from the liveness of the January meeting. We're less likely to get any big surprises there. There was discussions that they could announce the end of net purchases, for example. I don't think we're going to get that now. And the other thing was, he mentioned it takes about 2 to 4 meetings for the committee to reach this decision on the details around QT. And if we include the December as the first discussion meeting, that gives us May to June timeline for where they could come up with a little bit more details around quantitative tightening.
Okay, I know you mentioned it there, and I'm sure all of our listeners know, but just for completeness, when we say QT, we do mean quantitative tightening. So the other, I guess, bit of news out of the US, and we are recording this literally fresh after, so I've not given you a huge amount of time to gather your thoughts, but we had a slightly stronger than expected inflation print today, but actually the market reaction is probably the opposite to what you would expect to a stronger than consensus inflation print. Does that go back to what you were saying kind of at the beginning of the podcast about this kind of hawkish shift being quite well priced in now?
Yeah, I think so. I mean, inflation is running at a 7 handle. There has to be a big delta for the markets to really say the Fed needs to go much faster. March is priced in for an 80% probability of a hike. I mean, they can push it to, I guess, 50%, but not at slightly above consensus. I mean, things really have to spiral out of control, I think, for the market to really be, they're going to go a little bit more aggressive. At the same time, I mean, we're still looking at the details of the breakdown. Like you said, it just came out. Seems like used cars are again the usual culprit, driving the large miss against forecasts. But I think the conclusion here was that the market was pretty well priced in, and there needed to be a serious upside downside move to really change the stance of the Fed. If it came 0%, for example, month on month today, that would still leave inflation at like a 6 handle. So the Fed has not really pulling back from the direction they are. They're also not going to go any faster, not from what we get from today. So I think the market reaction is appropriate, more or less, or at least not surprising. And going forward, inflation should decelerate over the next couple of months going to the spring as the base effects wear off. And going to the summer, it should start sidelining according to our economics forecast. So, but mind you, we still have about 3% PCE by the end of this year, which is still well above the Fed's 2% target.
Okay, that makes sense. So I guess just to round off the discussion with, with the Fed and inflation and policy, last week you kind of talked about a tentative timeline for policy for the rest of the year, but I guess probably most importantly, the timeline now for quantitative tightening, QT. I think over the past week, you've kind of finalized that outlook. So can you just give us a rundown now of what we're expecting in the next few Fed meetings and when we can look out for announcements and everything else?
Yeah, we did finalize after we recorded the podcast last week. So now we're looking at, again, 3 hikes for this year. We're looking at March, June, and December. And we think there's going to be an announcement for the balance sheet rundown or quantitative tightening in September to start effectively beginning of October. The September call is a very close one. It could be June, it could be September. I mean, we're not really strictly set that saying it has to be September. It could roll down to June depending on how fast things evolve. But my inclination is that they would go to September because the Fed's main tool of addressing policy needs is through interest rates. So if they only hike once and still really haven't moved the needle that much in interest rates and immediately move to balance sheet normalization, it just feels like they're moving past that step a little bit too quickly before allowing for their main policy reaction tool to do its work. On the other hand, they will be faster this time. The whole cycle will be much quicker. So it's not really surprising if we get a June announcement, but I'm still more inclined to think that September is a likely meeting. I mean, it doesn't have to be quarterly. We're just basing it off on previous experiences. They could also, nothing stops them from going in July or May, but our base case remains for a September announcement.
Okay, thank you, Jan. All right, then over to the UK, Theo. We've seen some quite big moves in inflation expectations this week in the UK, particularly at the front end of the curve. What's really been going on there and what's been driving that?
I think the very interesting story here is that the UK inflation market in 2020, it was a market that it did surprise to the upside. We had strong prints, strong RPI prints, and we had really inflation expectations going wider and wider. If you look at things such as the one year forward, it ended up at some point trading at almost 480. Now, what we've observed in recent weeks, really 3-4 weeks, is a significant collapse in front-end inflation forwards. And to us, this is very interesting because the inflation narrative has not gotten particularly weaker. Yes, there is volatility with regards to energy costs, and energy costs are really all over the place. I mean, we used to see, 15 to 20% increases or decreases of specific futures contracts. But again, it's not that we've settled at a much lower level or that something substantially disinflationary has happened. So in our view, some of those inflation forwards in the UK start to look particularly low. But it's also very interesting, what is going on with the rest of the curve. And I would say when I look at longer break evens, I think there again they are still quite cheap, even though less cheap than where they were early in the year.
How does this fit, I guess, against BOE policy expectations and the idea that there could be a policy mistake from the Bank of England?
Actually, this is a fantastic point, because the question that one needs to ask is, okay, fine, how do you tie this in with rate expectations? And when it comes to rate expectations, we've got a bank rate at above 1.3%, by the end of 2023. So we've got, it's now 130. I'm checking the numbers. We are now 130 for SONIA rates by the end of the year, which is quite punchy. So the market probably assumes that the BOE will deliver that policy mistake, or that they will deliver, very fast tightening this year, and then that will have implications in the year after. And this is why the one year forward is so weak. I mean, this is one explanation that I could give to that. But to me, it's very interesting because the BOE, they are aware of that, and they know that they monitor those numbers. They know what's going on in the market. So if you know that there are risks that you may be committing a policy mistake, and everybody tells you that, well, probably you will be careful not to commit a policy mistake given the reputational risk of such a policy mistake. So in our view, we think that this policy mistake story is more used in terms of an interesting story, something that can create headlines, rather than something more fundamental. And we think that the BOE will actually be more patient. This is why we expect the bank rate to reach 0.75% by end of the year, not to be above 1.25, which is a significant difference when it comes to the timing of the hikes.
And then I guess I know it's still far away, but beyond the end of this year, then do you see the bank rate still gradually rising beyond 0.75%, perhaps towards that 1.25, 1.3 level, or do they get to 0.75 and have to pause?
Yeah, I think this is probably the billion or the trillion pound question. It's very critical what happens with the rate. In our view, it continues rising. It keeps rising in 2023, and this is important, and this is where we are different. So we think that, yes, this 125 is not particularly high, but the timing is very odd, that everything will be delivered this year, and then next year, absolutely nothing. So we struggle with that. We think that you can have, one hike in February, another one in August, and then you can have again hikes in February and August of 2023, which takes you to that 125, but it takes you to that 125 at a more gradual path. And you have the opportunity as a BOE to pretty much assess rather than blindly deliver hikes and then pulling them back. The other point that we need to say is that it is an opportunity also to test QT, and to what extent this QT can be delivered. So in our view, the BOE, they do want to test different bits. Now, you probably don't want to test them all at the same time, and you want to be cautious rather than taking too many steps and then, having to backpedal.
Yeah, that makes sense. Well, I'll let you into a secret. I have to remortgage at the end of this year, so I'm even more biased than normal to hope that NatWest Markets view is right versus the market. All right, last but not least then, Giles, we've had strong inflation in the US, and then since we caught up last week on the pod, we've had slightly stronger than expected inflation in Europe too. Do we think that this is the peak now of the inflation cycle? Is it all kind of downhill from here, or is there more strength? I guess particularly with regard to Europe, is there more strength to come?
I mean, it's probably the peak. That's our base case. The really interesting thing is not whether it comes down, but just how fast it comes down, right? I mean, in 3 or 6 months' time, will we still be as confident as we are now that we will get back to the inflation target in a couple of years? And I think that is as uncertain as ever. And we're really not going to get we don't have a clean read on that at this point. We're going to have to watch and see what happens to things like wages over the coming months. So yeah, I mean, it's a high number. It's pretty comfortably the highest ever in the history of the series. So pretty eye-catching. But we shouldn't get overly focused either on that or the fact that it comes back down from there, to be honest with you. Just on this point, I mean, I'd just like to say, just to illustrate the degree of uncertainty. I mean, I thought it was interesting that in Schnabel's speech, we haven't had a lot of ECB speakers actually really since the start of the year. But Isabel Schnabel made the point that if you make the assumption that energy costs continue to contribute to inflation at roughly their average total contribution over the long term of 2 or 3 tenths of a percentage point, then that would actually put you at 2% for your forecast, or that would have put the staff forecast at 2% at their inflation horizon. So, there's all to play for.
Yeah, still a lot of uncertainty around, I suppose. Now, the other high number that we've had this week, and that was a bit of a tenuous link because it's nothing to do with inflation, but never mind, is with regard to supply. Now, we spoke briefly about that, I think, on the pod last week, but obviously it's kind of continued into this week. We've had a fair amount of supply in the euro area. I guess SSAs have been leading the way, but it's been quite a heavy week. How well has the market been digesting that supply, and how well do you think it might digest it, for the remainder of January and Q1 going forwards?
Well, so far it's all gone pretty well. I mean, some of it's gone very well, to be honest with you. I don't think that that's necessarily too much of a surprise. I mean, the supply is always sold, right? It always finds somewhere to go. I think we started off the year with some feedback from real money type investors that cash positions were relatively high, particularly in credit. It seemed like there was reasonably strong demand. So I think we are seeing that. I think the really interesting question is going to be, first, how will investors want to continue to buy? Will they be buying out of cash at these sorts of levels? Will they be buying against swaps, or maybe because swap spreads are already pretty wide, maybe they'll find government hedges? And if more than usual is hedged, then what's the total duration impact of that? At the moment, we're not seeing much of an impact on asset swaps, and I think that's certainly surprising me a little bit, and I think that's probably surprising quite a few people, to be honest with you. So that is one thing to watch. But then remember that this time last year, the supply in early January was also taken down very, very well. And it was only in February that the kind of frustrated, the frustrated demand from the latter part of the year, when supply is lighter and the cash has kind of been put to work, and people go, right, so where are we? We've done what we thought we had to do, but actually, did we do that at the right sort of level? And then there was that big correction. And so I don't think that the read from the early year supply having gone reasonably well is obviously bullish at all, and it doesn't really it doesn't change our bearish conviction at all, to be honest with you, at this point.
Okay, now my $1 million question for you, since I had
that
one.
Wasn't it?
No, that was not it. When are we getting to zero in 10-year bond yields? We're so close, but kind of hovering.
Well, yeah, exactly. I mean, it should be this week, really. I mean, I guess the CPI wasn't quite high enough. We've got, we've got US supply this week, 10s and 30s, and last year, big corrections. I mean, US-led corrections were often associated with US supply events. I think it's probably too early in the year for that, to be honest with you, and it doesn't seem like the other conditions are necessary. That the overall level of uncertainty doesn't seem high enough. But I still think I wouldn't be. Let's put it this way. I'm going to answer your question by just saying I wouldn't be surprised if many listeners wonder why we're even asking the question, because we're already there.
All right, there we go. Bondcast listeners, you heard it here first. All right, everyone, thank you very much for joining me this week. I think that's probably all we have time for, but we will catch up again next week. And just a reminder to our listeners, if you liked today's episode, please hit the like button to show your appreciation and click subscribe so you can get the latest episodes in your inbox as soon as they're available. Thanks, see you next week.